Alright, so we come to part 3 of the lesson, and I promise you this will be the last part of this lesson. Okay, in the previous part we have seen that if the put call ratio is less than 1, then the chances are that the price or the market may go up. But just in case it did not go up, then from a certain lower level it will pull back. The market is said to be oversold and buying will start from a certain lower level of the PCR. We have seen that. Okay. Now what happens when the PCR is greater than 1, is more than 1? When the open interest in put option trading is more, when this numerator becomes bigger, then obviously the ratio will be more than 1. What happens now? See, we have seen earlier that when the open interest in call options was more, when this call was bigger, this call, then we said that the big sharks were hedging their portfolio by selling call options. Though their view was bullish, but still they were selling call options to hedge their portfolio. Isn't it? We have discussed that. But now when the open interest in put option is more, when this denominator has shrunk, the numerator has grown, do you think the big shark will hedge their portfolio by selling put options also? Obviously not. If they fear that their portfolio has a downside risk, their portfolio of Tesla or whatever, if they fear that the price will go down, then they might as well buy put options. They would invest in buying put options. They would not sell put options. Selling put options would be disastrous, isn't it? So now when PCR is more than 1, let us see who is doing the buying and who is doing the selling of the put options. Let us get a clear picture of that. Who is going to buy put options? Whom does it benefit? The small time traders who think that the market may go down, the market may take a dip, they may want to buy put options so that if the price goes down, if the market goes down, then they may earn by buying put options. This is what the small traders think and do. But we are not following the small fish. We are not following the small traders. We want to find out and do what the big sharks are doing. So this option we don't give it due importance. We will not consider this. Okay. Of course, the big sharks are also buying put options. Why would they buy put options? To hedge their portfolio. If they have a bearish view, if they think that their portfolio in Tesla or whatever is likely to go down in value, then they will purchase the put options so that if the market goes down, their put options will give them money, isn't it? So possible. They are wise people, will consider this. Okay. And who is going to sell the put options? Who is doing the selling of put options? See, the small time traders would generally not sell put options. They don't have that much deep pockets. Selling put options require huge risk, huge money, a huge courage. I don't think small traders normally would not indulge in selling put options, or rather any options. Okay. Of course, the big sharks are doing some selling. Why would the big sharks sell put options? If they have taken some short positions in futures, you see, if they have taken some short positions, if they have sold the futures, expecting that the price will go down and they will gain from the futures, but just they are worried, they have a fear that what happens if the market does not go down? What will happen? They have purchased the futures, all right. They have shorted the futures, all right, but they will gain only if the price goes down. What if the price does not go down? Then at least they should be able to retain the premium by selling the puts. Okay, so that is possible. They may sell put options to retain the premium just in case the price does not go down. So on one hand, the big sharks are actually buying put options based on their bearish view. On the other hand, they are selling put options based on their neutral view. All right. So what happens is that when the put call ratio is more than 1, the opinion is not very decisive. The small traders we are not considering, but the big sharks, they are buying the put option also, they are selling the put option also. So the decision is not very clear. So what happens is, how do we interpret that? We consider that when the PCR is in the range of 0.9 to 1.1, somewhere between here, the overall sentiment is bullish. Okay, overall the sentiment is that the market will go up. Okay, but when the PCR goes above 1.2 with a bullish sentiment, if the market keeps going up, when it goes above 1.2 here and the market keeps rising, then the sharks become very cautious. They are losing the premium they have paid on buying the put options. See, they have bought the put options and they have paid the premium on that. If the market is rising, they are losing the premium on the put options, but they are still happy because their portfolio is growing beyond expectation. You see, Tesla, which was at 200, if the price is growing, if it is becoming 250, they are very happy with their portfolio. Okay, but they are cautious because they are losing the premium on the put option. So at some stage they say enough is enough. They say the market is now overbought, we cannot continue buying, or we cannot allow buying more, selling has to start now. So what they start doing, at some stage they will start selling the shares from their portfolio. Remember, their portfolio is growing, but their put option is losing money. So they sell some shares to make up for the loss in the put option. Got the point? That Tesla, which had become from 200 to 250, now they will sell some of them to make up for the loss which they are incurring in the put options. So the selling begins. Because of the selling pressure, what happens? The market starts falling. Many sharks like this person start selling different. Some will sell Tesla, some will sell Apple, some will sell Tata Motors. So the market will start falling because of the selling pressure. So the PCR starts coming down. Okay, where will it stop? Here, 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 here. Where will it stop? We don't know. Okay, so now to sum it up, we can conclude that when the PCR is in the range of 0.9 to 1.2, the overall sentiment is bullish. Okay, and when the PCR comes to the lower threshold, somewhere here to the lower threshold, the market is oversold. Okay, the market will now start pulling up or pulling back, because people will start, you know what, if it is oversold, the people will now start purchasing and it will start going up. Okay, buying will start, and at some stage here at the upper threshold, the market is overbought. If it is overbought, then the selling will start and it will start, the PCR will start. Okay, but now the $1,000,000 question is, as small time traders, what can you do? This is the $1,000,000 question for which you have enrolled for the course and why you are watching this lesson, isn't it? What can you do as a small time trader? As a small time trader, you can sell when the market is overbought. When the PCR comes somewhere here, you start selling. When the PCR comes somewhere here, you start buying. Very easily said. But how will you decide where is the overbought position? Here, 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 where? At 1.1, 1.15, 1.2, 1.3, 1.4, where exactly? Theoretical concepts, all right, but actually where? And similarly, when it is going down, where do you decide that it is oversold? At 0.8, 0.7, 0.6? Where? So the answer is that the upper and the lower threshold levels are not sacrosanct. They are not sacrosanct. If it were sacrosanct, if I knew where it will stop on the upper end, and where it will stop on the lower end, I would not be teaching. I would be a multimillionaire or a multi-billionaire. So the upper and the lower threshold levels are actually, they depend on different things. They will vary from stock to stock. They will vary from index to index. They will vary from time to time. They will vary on the overall sentiments. So therefore, different experts will tell you different threshold levels. Okay. I will tell you something different. I will tell you 0.6. Another person will tell you 0.65. Another will tell you 0.55. So use your analysis and then put a stop loss. You cannot always be right. So just in case you go wrong, then your stop loss should help you. Alright? And the threshold will also depend on various factors. Like whether you are in the global bull market or a global bear market. How is the global economy performing? Is the global economy in doldrums or is there cheerfulness all around? How is the Fed likely to modulate the monetary policy? If you are closing towards the monetary policy every few weeks, then all eyes will be in the Fed on the Fed policy, how they are going to tweak the rates. That will topple the cart. And how much foreign money is flowing in or out of the country. Is there any tension of war between two countries or is there all peace around? How is the oil price moving? How is the OPEC modulating the oil price and the gold price, of course? So on various things, the PCR will keep changing its threshold level. Sometime between zero point 0.6 and 1.2, sometimes between 0.5 and 1.1. So it will keep changing. Therefore, before you jump into trade, you have to observe for a few weeks. You observe how the PCR and the market are correlated. For a few weeks, you keep observing. Okay, how and where the market is changing direction based on the PCR. Keep a watch, and then you will realize where exactly the market changes direction. PCR as a technical indicator works better for day trading. If you are a day trader, PCR works better for you, or at the most, if you are wanting to keep your position for a week. But if you want to keep for a longer period, longer than a week, then you know what happens. Sometimes the external news, some news comes in, some political agenda, some other factors, somewhere some strike or some talks about war or some monetary policy. These external factors start influencing the PCR. So PCR will certainly change direction, it will fluctuate. Therefore, PCR is not advisable for longer trades. At the most, daily is okay. At the most, if you want to keep the position for a week. Okay. So what I have told you is observe in what range the PCR gives a bullish trend. We have said 0.9 to 1.1, but then you observe it for a few weeks. Whether is that really the range in which the PCR is giving a bullish signal? Then you observe at what upper threshold the PCR gives an overbought signal, till where it is going and then coming back. 3-4 times when you observe, you will realize, okay, this is the mark. Okay. Then you also observe at what lower threshold it is giving oversold signal. You see, we saw when it comes down, till what level? 2-3 times you observe, okay, it has come till 0.06 and gone up. Second time also it came till 0.59 and gone up. Third time also it has come till 0.61 and gone up. So generally around 0.6 it is turning back. You would know. Okay. It will then after a few months it will change. If the season changes, if the sentiments changes, that range will change. Okay. And this you have to do for your chosen stock or your chosen index. I have told you that the range does not remain universal for everybody. For different stocks, that range will be different. For different index, that range will be different. You will have to observe and see. Okay? And then take a trade accordingly. And I have already told you, whatever you may do, please never forget to put a stop loss. Just in case your decision goes wrong, your stop loss should protect you as it has been protecting me always. Okay? Never take a trade without a stop loss or without a cover position. Okay? Before we close, let me caution you on one more aspect. You see, the market is not very obedient. Whatever you tell market to do or whatever you expect her to do, she will not do that. It will not move from one end to another. If it starts coming down from 1.2, it is not that it will come to 0.6 and then start going up. Or if it is going up to, it is coming down to 0.6, it will not happen that it will come exactly here and then it will start moving up. No, it will not happen. Sometime in a bullish market, it may move within this range between 1.1 and 1.2. So by your observation over a week or 10 days, you will see where it is going and how it is behaving. When it comes here, it is a resistance, you sell. When it comes here, you buy. Okay, the range may be like this. Or if it is an overall bearish market, if the overall sentiments are bearish, then it may move within this range, zero point 0.6 to zero point 0.7. It may not even come beyond 0.7, or sometime it may move between 0.7 and 0.9. It'll keep moving here. So only by your observation, you will be able to find that out. Don't trust anybody. Don't believe any experts. Okay. So I hope the concept of PCR and how you trade with the help of PCR, put call ratio, is now very clear to you. See, PCR is not the only indicator, but indeed it is one of the very important ones. And I have seen many small traders who do their trading based on PCR alone. They don't look at other things at all. Only when the PCR comes to a particular range, they will sell. When it comes to another particular point, they will buy. And they will do it for very short gains. Of course, these things, as I've told you, are meant only for day trading. Okay. However, you may like to supplement your analysis with the help of few other indicators also. If you are looking at PCR, you may want to support your belief with the help of a couple of few other indicators also. Alright? But again, a word of caution. You need to observe the PCR for quite some time before you actually jump into the trade. You should understand the movement of the PCR as you understand the signals given by your pet. If you are having a pet dog or a pet cat or something, any pet animal, you would understand the signal that when they want food, when they want to go out, you understand their signals. So the same affinity you should develop towards PCR. How it is moving, by looking at it, you will develop with practice. You will develop, a relationship. You will come to know now the PCR is going to change direction. All right. So here we come to an end with the indicator called as put call ratio. All right.